Investors or traders are no doubt familiar with dividends, the icing on the cake when it comes to the many stocks available on the market. Now, if you've been following my channel, you may have noticed I do occasionally make a point of companies that offer a decent dividend. In this video, I'm going to explain what I think dividends are a very important part of stock selection and what I think investors should be looking for. Here we go. So to understand the value of dividends, here's a very methodical view of the stock market. Shares on the market are an opportunity to own a portion of a company, and there are internal and external factors that determine the stock price. Internally would include the price at IPO, which is determined by the perceived technical value of the company, based on its ability to earn cash now and in the future. After IPO, the company can continue to affect the price through the dilution or buying back of shares. Externally, the share price is determined by how investors perceive the value of the company and its ability to perform in the future. Investor sentiment is extremely powerful, as even if the company is performing well, growing in revenue and profits, negative media attention for any number of reasons, from volatility in the general market to idiotic tweets from CEOs, can have a devastating impact on the stock price. And it's during these volatile times when their investments are at risk, it can be tempting for investors to sell in favour of cash. There's also the issue of competition, where other companies, particularly those in the same industry, may offer a better investment opportunity. This is particularly the case when it comes to competitive industries, where companies can shoot to the moon or burn in hell in a very short period of time. Consider the mobile phone industry, where we've seen Nokia, Motorola, BlackBerry, HTC, many mobile phone companies that fail to keep up with the innovation, brand appeal and quality of their rivals, Apple and Samsung. So, investors bailed on those companies and bought up the competition. Apple and Samsung have grown to dominate the mobile market, and as their stocks continue to climb to record highs, what was once their competition has gone the other way. So investors can be quite fickle when it comes to their investments and will often move like monkeys, swinging from one branch to another until they find an investment they can stick with. It would be wonderful if companies were valued only by their fundamentals, so investors who pick the best valued investments were rewarded with returns based on solid performance and not sentiment.
I'm rich.
Unfortunately, sentiment seems to be heavily influenced in this current market, not fundamentals. And that sentiment, the impact of emotions into buying stocks, the FOMO, YOLO, the fear and greed index, is a poor method of stock selection. So for companies to counteract this, there needs to be an element of consequence. And that's where dividends come in. To explain this link, there's a metaphor known in game theory. This is the prisoner's dilemma. Imagine two prisoners accused of a robbery. The prosecutors know both are involved, but they don't have the evidence to convict, so they present three options to the robbers. If they both remain silent, they can only be convicted of a lesser offence and will both serve 1 year each. That's 2 years in total. If one confesses and testifies against the other, the confessor will go free, but the other will get 5 years as a sentence. However, if they both confess and blame the crime on the other, then they will both get 2 years each. That's 4 years in total. Now, the investigators place the prisoners in separate cells where they cannot communicate with each other. Now, if we think about this logically, the pair are better off if they both remain silent, but by separating them, they are playing into each prisoner's emotions, their fear of what the other might do. Each prisoner knows it's in their self-interest to confess and blame the other, go free whilst the other serves 5 years. And the fact that they are thinking this means the other must be thinking this too, and they don't want to serve the 5 years. Because of the role of emotions, the most likely outcome is both confessing and serving the 2 years. That's 4 years in total. Likewise, during volatile periods in the market or bad news from a company, investors are put in a very similar situation. They could hold their stocks, they could even buy more, but they will lose out if other investors sell. So out of fear of that happening, they could act within their own self-interest and sell whilst the stock is on a high. This isn't great for investors or the company, when a fast sellout for investors can be devastating to a stock price, sending it into freefall or impacting similar companies or the market as a whole. And that's why dividends are an important tool in counteracting this emotional decision making and protecting investments. Dividends act as an incentive to stay with the stock over volatile periods, and a consequence for investors who sell out. Also, as the stock falls, the dividend yield goes up, so it acts as an incentive to buy into the company. So during times of volatility in the market, dividend stocks tend to be more stable, holding their positions much better than non-dividend stocks. Additionally, long-term data for companies within the S&P 500 has shown that dividend stocks generally outperform non-dividend stocks. Of course, there are non-dividend companies that have rallied exceptionally to extreme highs, particularly certain large-cap companies over the last 2 years. But this excelled growth during exceptional circumstances in the market is not sustainable. Those stocks tend to be more volatile, falling even faster once they drop an earnings report that misses expectations. Just look how quickly Facebook crashed after one bad report. But this doesn't mean that investors should go out and hunt down the stocks with the biggest dividends. Dividends are paid out of a company's profits, so they have less money to reinvest into the business and they grow at a slower rate. So there is some debate on whether dividends are better for stock growth. Dividends are never guaranteed, as the company needs to be profitable, so rather than blindly buying into stocks offering the largest yields, it's important to check for a steady record of cash generation and dividend payments, so you don't end up buying into a value trap. Also, although dividend stocks can be more stable than non-dividend stocks, they do have a unique kind of volatility. There are 4 dates you need to be aware of when it comes to dividends. The declaration date is the day that a dividend amount is agreed by the company board and announced to shareholders. The ex-dividend date is the date set by the stock exchange where shareholders would no longer be entitled to the dividend, meaning you have to own the stock before this date or you miss out. The record date is the date that a record of shareholders is provided to the company so they know who to pay. And the payment date is of course when the dividend is paid out to shareholders, but this can be delayed depending on which broker you use. These dates can lead to a unique stock pattern due to dividend whores. These are traders who will buy into a stock just before the ex-dividend date, after which they sell out their shares and move on to another upcoming dividend stock. This behaviour creates a pattern when a stock rallies just before the ex-dividend date, after which investors see a big drop in the share price, often cancelling out the value of the dividend. This is particularly the case when companies are issuing a special or annual dividend, where the amounts involved are quite high. It's a disappointment to shareholders who have been holding on to the stock for a long time, through thick and thin, only to have someone come in at the last minute, take the same reward, and then tank the stock on the way out.
There now, Stevie. There are unpleasant surprises as well as pleasant ones. That was your unpleasant surprise.
A good example of dividend volatility is with Realty Income Investment Trust, which has a unique approach of paying out a monthly dividend. If you chart the data, there is some clear volatility, and it appears some investors sell out on the ex-dividend date and others reinvest back into the stock on payment date. Investors can try and play the volatility, buy low, sell high, but this assumes you know where the peak is. You could sell here, but then you miss out here. Or maybe buy here, assuming it climbs, but then it falls here. Trying to predict the market will most likely lead to losing money, one way or the other. Remember, the number one rule when it comes to investing is don't lose money. And the second rule is remember the first rule. Trying to time the market is not as effective as time in the market. Now, there is a case for investors who want to run a dividend investing plan, or DRIP for short, focusing solely on companies offering the best dividend rates and reinvesting those dividends to buy more shares, which increases the investment position, and repeating this cycle creates compound growth. However, we know that unless a company increases their dividend amount, when the stock price goes up, the yield goes down, and for that reason investors should apply a more methodical approach. Rather than invest back into the same company, acting out of some kind of emotional attachment, it is better to invest into whichever company on your watch list is offering the best dividend result. And being methodical like this can have a significant difference on just how well your portfolio performs.
Logical.
It's also a good strategy to keep researching the industries, on the lookout for a competitor offering a higher or more reliable dividend yield. Rotating your positions this way, selling the weaker investment and buying into the better one, keeps your portfolio fresh and maximizes your return on capital. Rather than stress on the highs and lows of the stock market, dividends offer an incentive to buy and hold on to a stock that may not be making the most massive moves, but offers a relatively reliable and stable return on investment. Although never guaranteed, a decent dividend yield can represent a company confident enough with their profit margins that they want to reward shareholders. I don't consider myself to have a dividend portfolio, as I'm not focused entirely on the highest dividend amounts, but I will take a consistent and growing dividend history alongside solid fundamentals, management and growth prospects as a recipe for a good long-term investment. Out of the 19 investments that I hold, 18 of them offer a decent dividend, and my average dividend yield is 8.13%, which isn't bad for investors who love a dividend. And dividends make me a lot more comfortable holding my positions during market changes, at least a lot more than I would be holding stocks that rely entirely on investor sentiment to drive the price up. And in a volatile market, it's nice to be comfortable about your investments. And that's my take. So if you have any thoughts or something you want me to talk about, please comment below and let me know. And remember, if you like what you see and you want to see more, smash that like button and subscribe so you don't miss out on any future videos. Until next time.